Now, in this segment, we're going to pivot and we're going to focus a significant amount on the international market. And we're obviously going to talk about the US and the exports and how that fits into the model. Because, I mean, just based on spreads, the US exports are going to remain fairly robust. So now when we look at Asia's, as we all know, the refining margins were just massive at the beginning of the year. And then I should say at the beginning of summer, but now they're starting to cool off. But when you look at diesel cracks, diesel is come back, but still remains strong. It's still obviously not at the levels that we saw in June, but gasoline is the problem. I mean, it is like the floor has fallen out, and it's because we have a record amount of light distillate in Singapore storage, in storage around the world. And Fujairah, and again, that is going to remain a problem because right at this point, diesel continues to be to carry it. But depending on the availability of crude, obviously you need natural gas to crack in terms of making the hydrogen, keeping the pilot light on, and natural gas LNG prices are through the roof. So you're starting to see some of that pare back on refining utilization rates, which is a bigger problem for distillate because we're not anywhere near normal on distillate storage, and we're already starting to see the cracks on refining utilization rates and those throughputs because gasoline is a huge overhang when you're looking at the underlying backdrop with jet fuel not providing all that much. But the diesel side continues to be, in some areas carrying it just a bit further. So diesel cracking margins in Asia have come under pressure. They've fallen 40% from their recent peak in late June, but remain more than double the level reached before the pandemic. So again, diesel is not the problem, but diesel comprises a majority of the export volumes for Asian refiners, but gasoline is the one that you have to watch as that dark horse of really starting to drive things a bit lower. Now, all the while, when we look at what is happening in Dubai, Brent, you can see that it's sitting just over $10. It's come back from the highs, but there's some staying power here, just given the disconnect between where everything is in Europe, what pricing is happening in Europe, and what pricing we're getting out of the U.S. And what we have a chart just showing how wide that disconnect has gotten between Brent and WTI. And that's why we expect, again, U.S. exports remain very robust. But we do have a physical limitation based on how much storage do we have, how many docks are available. Some of the canals are one-way traffic, so if we're importing, we can't export. So that's why it's going to remain lumpy, but again, it's at the higher end of that level. Now, there is some concern that Saudi Arabia is going to increase OSPs again. It's likely that they can do that, especially coming into Europe. They might not do it as aggressive as the market expects, but I think it's going to be important to look at how is that going to continue to move on the going into September. So oil spreads widen. WTI's discount to Brent blows out past $9. I think it's important to consider this because it's when you look at April 2020, WTI went negative, and that was the last time we had a spread like this. So when you look at some of these spreads in general, there's normally that quick snapback, but Russia flows have changed, and that's where we're seeing some of these adjustments. So the gap between global oil benchmarks has blown out in recent days as Europe scrambles to replace dwindling Russian barrels, while the U.S. remains relatively cushioned by strategic reserves, some 12.1 million barrels a day of production, and some slowing refining capacity as well, which is going to pad some of the storage. WTI's discount to Brent widened to as much as $9.24 on Tuesday. And as we are talking right now, it is holding in at about that level at the moment, which is the most since April of 2020. And we don't see a huge snapback right now, but you can see it usually gets a bit volatile because people are going to look at this and traders are going to look at this and try to close that arb, which is what we expect to happen. Now, when we talk about Saudi Arabia, this is the view where Aramco seen raising Arab light price to Asian buyers for September. So if they do that, and again, it's important to look at if they do that, it's because they're not seeing normal buying anyway. And this could also redirect some of the flow, because you'll have some of the contract buying or the term buyers that will either give up some of their term buying, or just opt to take the bare minimum, which would then enable Saudi Arabia to send more into Europe and the US. So you could see a bit of an adjustment. There's actually a bit of a cooling period that has happened, where in the US and Europe, there's a heat wave. In the Middle East, there's a bit of a cool down. Again, still hot. It's not saying that it's snowing there, but you've seen a little bit less demand on the electricity side, which is going to put a bit more into the market. And as we showed 2 weeks ago, they continue to import a lot of Russian diesel, a lot of Russian fuel oil, and exporting what they're creating and having that come into the Atlantic basin between both Europe and the US. So some Asian processors have started to mull a reduction in operating capacity from September after running at maximum rates in months. And that's more of on the refining side, and that's because gasoline is a problem, both in Fujairah and some of their areas where they dump into, specifically into Asia. Any pullback would carry the potential to soften crude oil demand in the coming months, because remember, oil refiners are your biggest buyers of oil, obviously, because these are the ones that have to take the crude and make it into something else. So as those run cuts start to accelerate, now they normally do, seasonally speaking, as we get into the middle of September, accelerating through October, but some of it could come a bit sooner, just given where gasoline is trading and gasoline is going, which would soften some of that demand ahead of schedule. Which is why when we talked 2 weeks ago about OPEC demand, some of these numbers, we just didn't see the same type of oil demand they did in terms of just what 2023 looks like, just given how we're exiting, or how we believe we're going to exit 2022. The bullish momentum for Middle Eastern crude is likely to reach a turning point next month for October loading cargoes. Traders who buy and sell, citing a decline in refining margins. Gasoline cracking margins in Asia have tumbled 70% since late June, while, as we said before, diesel is about 40%. The spot premium for Abu Dhabi's Murbain crude for October is seen declining at least $1 compared with shipments loading in September. Physical cargoes of September loading, Murbain crude, favored by Japan, Asia in general, traded at more than a $10 premium to Dubai benchmark. Futures slid more than $4 on the ICE futures. So Saudi Arabia, the de facto leader, obviously, of OPEC, the GCC, is looking to, as the wider group is looking to assess supply policy next week. So again, we're going to get a little bit more color of, are we going to get more production from the Middle East? And I would say we'll probably get whatever they've agreed to. I don't see much more, just because West Africa and Russia remain the biggest drivers of the decline in production, but we're seeing some of that slowdown on demand. So I'm not sure we'll see a big shift. And as we showed last in segment 1, I think this drives it home. Russia continues to, again, block out that Middle Eastern crude going into India. But it's not just the Middle East that's losing it. It's also, as we said, the West Africa and even U.S. So the share of Euro-Asian region, which includes Russia and India's overall crude oil imports, reached a record of 18.8% during April through June, but it was 3.4% in the preceding 12 months. To give you an idea of the huge increase that we're getting into India. And as we said before, we have 4 cargoes of ESPO skipping China and actually coming and flowing all the way around into India, just because that demand remains robust into the country. So now when we look at global crude oil on the water, as we've been saying, miles per ton are growing. More and more cargoes are sitting on the water, traveling further, which is why we're getting more crude oil on the water. You have floating storage remaining above normal, but transit setting new records, driving a large piece of this. And as you can see here, oil in transit is setting seasonally adjusted all-time highs, and we think it's going to set new 2022 highs And then the question is, when do they show up into floating storage? And that's why as long as crude oil in transit remains at records, we're going to see floating storage also remain at the highs due to the different shifts in flows. You can see it's now just below 2021 levels, but we expect that to continue to creep higher and just essentially track where we were in 2021. So now when you look at Asian floating storage, here's where you start to get that acceleration higher. We expect to see some of that, especially as you still have a fairly slow activity on the refining front. Now they've slowed down purchases, but they're still taking in some of these cheaper cargoes, trying to be take advantage of the discounts when they're available, which is what China is good at doing, and that's going to keep things again moving fairly higher, even as demand has slowed. But that's on the state-owned and the mega side, because the Shandong guys are breaking back out to highs. That's against the 3-year average. That's against where they were in 2021, currently sitting at 69.4%. And that is still, and it's funny because China, or I should say the government, the CCP, keeps trying to essentially knock these guys down. But every time they keep doing that, they keep them on the other side. They show why they're still so relevant, because while the other areas just can't push, can't really fill what they need, they then turn around and rely on the Shandong guys. But they're also forcing them to actually import back in the country at a loss. And that's, again, creating some of this disconnect and honestly some anger amongst, which is what we talked about in segment 5 of the Econ show 2 weeks ago, where there's actually some friction or growing friction between Shandong, within Shandong, within Beijing, as well as within Guangdong, versus what's happening with the CCP. But we'll talk more about that tomorrow. So West African crude oil floating storage, seasonally adjusted highs, continuing to drift higher. We did see some clearing of cargoes, but nothing crazy, nothing huge. And as we get more slowdown, especially into India from West Africa, that's going to result in more crude into floating storage. But we don't see it getting back to 2022 highs, because even though you have India not buying as much, you have Europe and the US buying more. So that's going to balance some of that out, which is why we're not going to get back to those peaks that we saw. Excuse me. And here's when you look at China's super tankers, and it continues to be fairly flat on the lower end, and that's back to what we've been talking about on the driving force, which is just not as much purchasing given the amount that they have in storage already. Now, as we showed the huge disconnect between Brent and WTI, it's not a surprise to see a big spike in crude oil, in crude product exports. Excuse me. You can see here there's about 789,000 barrels a day more, bringing us from about 3.76 to about 4.5 million barrels a day. We expect that to drop back down, but closer to about 3.4, still remaining well over normal. Finished gasoline, as we've been saying, is going to stay above the 5-year average. It fell just slightly, 38,000 barrels a day, but they need to move this gasoline out of the market. Distillate had a drop of 147,000 barrels a day, still above the 5-year average. And again, they're trying to balance their market because Pad 3 continues to not have the supply issues that Pad 1 has. So they're trying to capture the external market, especially on the disty side. So that's where you're seeing some of those opportune flows. Where propane, propylene, gangbusters up 46,000 barrels a day, well above the 5-year average. That's going to stay strong in general. Now, when you start looking at total finished gasoline, we were saying we expected to be well above the 5-year average, but just below that top of the cloud, and stay fairly strong as we head into the remainder of the summer. Distillate we thought was going to stay either just below or just above that 5-year average. Here you can see that nice breakout. We do expect that to drop back down, but really not fall below the 5-year, just stay an average just above that 5-year, just as they try to manage their storage and maintain runs, because gasoline's a problem and they want to maintain some of those underlying flows. where ethane exports, again, surging back to highs. We don't see that changing in the near term. And then when you look at crude, breaking to new all-time highs, new 2022 highs. But that's not sustainable just given the underlying restrictions on infrastructure. So you will see that drop back down. It will, but again, that still will be well above the 5-year average, well above the cloud in general, because again, you still have that demand, which is why when we talk about the 4-week rolling average on the on crude oil exports, we expect that to remain well above and closer to about that 3.4 million barrels a day. Propane, propylene, again, hugging the highs. We don't see that adjusting as additional flow continues to move into the international market. Now, when we look at some of the flows at the moment, here you can see where we are on as we head into September, in August. Norway sitting at about 1.59. We don't see that changing just given where economics are in the region. Russia is going to try to hit about that 4.1 as they continue to see some of that closing out. Angola, a little bit higher in September, but again, still struggling. We've had some deferrals, which is why you see Nigeria struggling a bit in August. Some of that is getting deferred out and coming back to, even though they're missing target, they're still struggling to, again, get some of that clearance that they need, while a lot of the others continue to move forward. Now, Libya has been able to maintain above production. So remember, production was about 570,000 barrels a day, but they were able to export closer to 620,000. That's just because they're relying more on storage. There are storage tanks on the coast. But as some of that adjusts, we'll see exports move closer to about 1.01, 1.07, back to where we were in both March and April. So now when we look at pricing, Vital lowered its offer price for a shipment of Dahlia crude. India Oil purchased 3 cargoes combined of Angola and Nigeria crude. Vital offered 950,000 of Angola's Dahlia, loading at $1.05 more than dated Brent, which drops from $1.30. Remember, they were trying to drop these down, finding that clearing price, getting out into the market. And India continues to be opportunistic because right now they have to try to compete with that ESPO. In general, India's ramped up purchases from Russia. 4 vessels hauling Russian ESPO oil are making their way to India, with 2 tankers heading for specific ports on the East Coast. And again, they're not only taking what's coming from the Ural side, but they're now also taking ESPO, and that's going to drive down West African flows. Angola crude for August loading is now mostly sold out, with only 1 or 2 shipments yet to find buyers, which drops from 3 to 4. Again, fairly normal for this rate. It's still below what is normal, historically speaking, but again, this is normal for this period of time. Fewer than 10 shipments of Nigerian crude for August are still awaiting buyers out of more than 40 planned. And then Gunvor sold Fortes to BP for August 2022 loading at 470 plus dated Brent, which compares to 440 from the previous. So again, you're starting to see some of that premium remain, which is why we do see that staying power in dated Brent, that pressure remaining there, while West Africa comes down a bit. But really, Russia continues to take a lot of that demand flowing into Asia. The problem is that demand is shrinking just because of storage levels, just because of run rates. So when we look at Europe, you can see it's right at that 10-year average. We don't see it going much further up or down because we do see a lot of pressure coming into the market on the industrial side, which again is going to limit the amount of demand that is there on both the consumer side. So less oil, slowing refining activity, which is going to push this a bit higher. Nothing crazy, but again, we think it's going to set new 2021 highs. 2022 highs. Not getting to the highs that we've seen, but again, highs for this year. Gas oil continues to fall. We don't see that adjusting. We don't see it, but you can see, as we've been saying, it's just going to stay flat. And that's what we expect, which is actually a big negative when you consider where they are on the natural gas side heading into heating season, which is going to be a bigger concern as you get some of that switching. There's how much of it is possible, not a whole lot, because they've taken out a lot of that diesel backup gen. So there's not going to be a huge shift. There will be some, but you're going to see that prices will remain elevated in general. While gasoline continues to break to new highs, we're tracking 2020 levels. When you look at that yellow line, we expect that to continue to go up, just as you get demand just dropping much further down. And then fuel oil, fairly elevated. As diesel prices and ultra low sulfur, very low sulfur diesel remains bids remain very high. We do expect more fuel oil, more residual fuel, more heavy disti to get run into some of the third world and emerging markets. Now, when we look at the Singapore side, you have the total increases from 43.6 to 44.1. Fairly normal. As we've been saying, we don't expect a huge swing on the total side. And that's because light distillates we said are going to break to new highs, while middle distillate kind of just sits there. And then you have that flexibility with the resid. And now when you look at middle distillate, you can see just that small build, but light distillate's breaking to new highs. So here you can see we took out the 2020 high again. We expect that to remain. We're seeing a lot of slowdown in gasoline demand, especially in Asia and in the Middle East, which is going to put more of this in storage. All the while, you're getting some builds in middle distillate, but but just by this chart, you can see even though we're getting a build, you're still at record lows. We don't see that changing. And it's only really going to change in a meaningful way, but meaningful is relative because the rate of change is, we're not going vertical. It's just how much more additional fuel oil and resid will be run instead of middle distillate, especially but the problem is now because you're getting some of this balancing flow, even resid and middle distillate, heavy disti is fairly flat versus historics. But as you get some of that increase in demand, that's going to, again, increase pricing a bit and keep the pressure on the emerging market nations. And now when you look at Fujairah reported 22.374 million in storage. That's up 498,000 barrels a day. And we had a small draw on light distillate, while heavy disti and resid showed builds. So light distillate had a small drop of 149,000 barrels. It's still over 6 million at 6.4. East of Suez gasoline complex continued to experience downward pressure on the back of an expected reduction in import demand from Indonesia due to new purchase regulations on subsidized 90 RON gasoline and reduced demand from Vietnam amid reductions in driving demand. Again, everything that we've been talking about starting to show up. Middle distillate rose 387,000 barrels, still low at just over 3 million at 3.121 million. East of Suez remains range bound. Again, as we've been saying, we don't see that range breaking one way or the other, just as you get some of that conversion away from middle distillate towards the heavy side. Heavy resid rose 260,000 barrels to 12.8 million, holding above 12 million for the fourth consecutive week. That's just because we have a lot of muted bunker sales, and that's what we've been talking about with that slowdown in shipping, which is going to continue to be that overhang. And now Brent time spreads. Hello, Brent time spreads. And here you can see they're over at $4.88. Again, that's just going to support more flow just because there's that shortage due to Russia. So there's, Europe is getting hit on all levels when we're looking at some of that pricing on the energy front. North Sea crude floating storage, at the low end, it's going to stay at the low end just because there's that shortfall, which is going to keep that North Sea flow flowing. And now when you look at Middle East is fairly flat at this point, and just based on where these flows are going. Yes, you're losing Asian flow, you're gaining European flow, so we expect this to stay fairly flat here on the storage side, which also could support a little bit of an increase in OSPs. So we do expect an increase in OSPs, which will likely set a record theoretically against May, which was the previous high. And then when you look at Europe, this is what we're talking about with where Europe is. We expect more of this to go from floating storage to onshore storage, keeping things fairly elevated on the onshore oil side. So that's what we have for you today. If you have any questions, you can find us on Twitter. You can find us in the comment section. Hopefully this was helpful, kind of putting some of this into context, because we do see a huge issue between gasoline and diesel when you're looking at cracks, refinery run rates, things that we've talked about, but we wanted to do a bigger show summarizing what we've been saying, because we think it's important, especially as we come into the shoulder season on not just the U.S., but on a global level. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.